Thanks so much for tuning into this conversation with the management of Dixon Technologies. They've come out with the numbers, and on a YOY basis, it's been a stellar performance, right? About over 250% growth YOY in sales, 11x growth in PAT. Of course, YOY may not be necessarily the best way to look at business simply because last quarter businesses were disrupted. But let's get in Saurabh Gupta. He talks to us every quarter to talk about how business has shaped up for them and what does he believe holds in the near term. Saurabh, good having you. Thanks for joining in. Um, it was a COVID impacted quarter, Q1 FY21 as well. How did it go? And the one thing that probably marred the numbers a bit were the margins. How would you respond to that?
Yeah, hi Niraj. So basically, you are absolutely right. The quarter one numbers have to be looked and contextualized and looked in the context that we had this whole second wave of pandemic, which was more ferocious, more deeper, and it impacted all of us. So clearly, mid-April onwards, we started to see the growth slow down. The lockdown started happening. It further got de-accelerated in May. So May was even worse than April. And then gradually markets started opening up in June. So there was a recovery in June. And now I can say that we are almost back to normal levels in July. And we have a very strong order book going ahead across all the verticals. Margins, one, of course, we had this couple of things worked which impacted our margins. One is, of course, the overall operating leverage, because we didn't cut down our cost this time as against the first wave where we cut down our cost. So there was significant adverse operating leverage that kicked in because there was hardly any volumes in some of the verticals. Secondly, the commodity costs continue to be high, and we are in a commodity super cycle where the commodity costs have been going up. It started going up from November 2020 or last year, and it's still continuing. Though we have been able to pass it on, but yes, it still impacts us, especially in our ODM business. And third, I would say, if you look at the revenues, almost 60%, 68% of our revenues have come from LED TV business, which is a prescriptive business for us, and where the gross margins and EBITDA margins is lower as against our ODM business of lighting and washing machine. So it is basically change of mix, the commodity cost as well as operating leverage. As far as the commodity cost is concerned, we have been able to pass on most of it to the customers through calibrated price increases, through inventory planning, through value engineering. But yes, it is somewhere it's continuously going up as well.
So Saurabh, you had guided towards this mix change happening in all of the last 2 or 3 quarters that we've spoken. So no complaints there. But my question is therefore that if commodity costs are not quite coming off, and while they may have cooled off a little bit, they are nowhere close to what people would want them to be, desirable levels, so to say. And this OEM, ODM mix continues to be skewed, if not in the same fashion as it was in quarter one, but otherwise continues to be skewed in favor of OEM, so to say, then would you come back to what was the normalized level of operational metrics, or you reckon for the foreseeable future pressure continues there compared to the past?
Yeah, so it will keep inching upwards. I think so. Quarter one is an aberration. So what will happen? So there are three things, Niraj. One is, of course, our growth in prescriptive business is more this year, led by LED TVs, and now mobiles will also start performing in Q2 and Q3. We have a very strong order book from our anchor customers. And going forward, we also got the approval under IT hardware products, and we're also now getting into telecom and networking products where we've already applied. Now, all these businesses are prescriptive businesses where the margins are in the range of 2.5–3%. So their contribution to the overall revenues have increased as a percentage to the company. So that's why the margins as an overall looks lower. Of course, there'll be significant growth in revenues and EBITDA, but the margins as a percentage will look lower. But my sense is we are also now getting into ODM categories like refrigerator, which we have already kickstarted, and it should commence operations by Q3 of next financial year. We will be putting a capacity of 0.6 million for direct cool and ultimately ramp it up to 1 million, which will be on an ODM business. And the margins will be 9 to 9.5% kind of levels. Similarly, we also plan to start a fully automatic washing machine, so the trials have already happened and samples have been shared, and we plan to commence our production by September. Again, it will take us time for us to ramp up. So next year will be a full year for us. Again, the margins in that particular vertical should be in the range of anywhere between 9 to 10%, similar to what we achieve in semi-automatic washing machines. So my sense is this year, the profile of margin should look like somewhere between 3.5 to 3.7 odd percent, because already you had one bad quarter in terms of margins. But next year, yes, with this ODM businesses also coming in and contributing and going forward, I think so the margins can go towards 4.25% in next couple.
But for you to average 3.75 as well, it will need to scale back to 4 or 4 in the remaining 3 quarters. You think that can happen even with the commodity cost pressures?
That can happen because the scale benefits will come in, and we clearly have an order book. So once the volumes come back, the operating leverage benefits also kick in.
Okay. What about operations? Are they normal right now? I heard you mention twice that June was anyways coming back and July is fully normalized. There's this whole fear of a third wave. I mean, God only knows if it happens or no. Hopefully it doesn't. But if it doesn't come through, then this current Q2 is a fully normal quarter for you.
Yeah, my sense is quarter 2 will have a good year-on-year growth as compared to same period last year. Yes, but a major, so month on month it is getting better, Niraj. So July, the order book is very good as compared to June. So June recovery happened. But in July now, I think so we'll go back to almost 85-90% utilization levels across all our factories. And August is also looking very good. So yes, we should have a very good Q2 ahead of the festive season. And there'll also be a bump up from our mobile business, which is kind of now ramped up and stabilized under the mobile PLI for our anchor customers. And Q3, we expect a significant bump up in our mobile revenues from these anchor customers. So every quarter, so my H2 actually should be significantly better than the H1. And a significant portion of our profitability will come from H2 of this financial year.
Okay, I'm guessing you're sticking to your guidance stated earlier, 10.5, 11,000.
So revenues wise, we feel confident. Yes, it can be. In fact, I think so. Niraj, it can be somewhere around 11.5, 12,000 crores. But yes, the margin profile will be somewhere around 3.6, 3.7%.
Which is understandable, and as you said, which will come back as well, which is fine. Just one quick follow-up before I get to a couple of other details. I would want to know what are the new things that you guys are doing, because you guys do a bunch of new things. But just one quick question. There was, and maybe I have missed it, but I just wanted clarity from you. Remember at the end of quarter 4, there was some conversation around what will happen to the mobile PLI benefits, because a lot of companies were not able to meet the criteria. Then FY22 as well has been hit by this first quarter, wherein operations might have been a bit or substantially impacted. What happens to last year's benefits, and how confident are you of meeting the targets that might have been set for year 1 or year 2, depending on what year this is for you?
Yeah, so government also was quite flexible and they listened to the industry. So actually they shifted the base, they shifted the whole PLI period from last year to this year. So now this year becomes the first year for us. But we already have a very good order book from our customers. We clearly see that we are confident that we should be able to significantly overachieve the ceiling revenues for this financial year. Earlier, the ceiling revenues for this financial year was 4,000 crores. Now it is 2,000 crores. But we clearly see that we will overshoot. In fact, to be closer to the 4,000 crores kind of a number for this year as well. So in that ways, we are a big beneficiary of this push by 1 year.
Okay, great. Now, Saurabh, what about the new things? I mean, you guys were in, I mean, you've been tossing and toying between the ODM and the OEM categories, right? What is it that you've done new this quarter? Are you in a position to be able to tell us not just on the product front, which I want to know, of course, but also if there are any large anchor tenant clients that might have come in any of the categories as well, if you are able to really talk about that.
So I won't be able to talk about specifically about customers, but customer acquisition is a continuous thing for us, and we continuously keep on acquiring more customers. Because see, Niraj, what happens that as you keep growing, your scale increases, the cost competitiveness increases. And the cost competitiveness helps you to get larger share of wallet from your existing customers and also get new customers on board. And clearly, we are seeing a trend that brands now want to outsource more and more manufacturing and focus on branding and distribution. So that is a continuous trend that we are seeing. So in new opportunities that we are looking at. So yes, one opportunity is refrigerators, which I mentioned. So where we have already finalized the technology partner our product design is in progress right now, and we have hired a project and R&D guy, and we now plan to come under the direct cool refrigerators, and we ultimately will create a capacity of 1 million. Initially, it will start with 0.6 million. The total market for India is around 10 million. So we want to be 10% of the overall Indian market. And we have started engaging with customers, and this should come up by Q3 of next financial year. Second is like we are also now deepening our relationship. So we have already started manufacturing for Boat, which is of course one of the top 5 brands globally in wearables and hearables category. So there we are in fact deepening our relationship with them and taking that relationship to an even more strategic level. And clearly a PLI is expected to come in that category as well, which will give a boost to domestic manufacturing. So there is an opportunity to back a big brand like Boat. So that will be a good opportunity for us. Third, Niraj, we are also evaluating. So a PLI for white goods came in, where for us it means 2 things. One is LED lighting components. LED, we are already the largest, and we have a 50% market share in LED bulbs, battens, and downlighters. So now we plan to get into components because that will further enhance our competitiveness. So that is in progress, and we'll file our application in September. And again, we already have a partner which does AC PCB for controllers, which is also a significant bill of material for an AC. So there we are working with that partner to enter into kind of a potential joint venture, so that the JV can ultimately apply under the PLI scheme. And if we are able to shift some of its supply chains from outside India to India, I think so that can also become a decent opportunity for us. So apart from that, IT hardware we got the approval. So we are working with a partner, finalizing the numbers and the profitability. And telecom and networking products, we filed our application, and we are awaiting the approvals. Hopefully by end of August or mid of August, we should get those approvals.
Sorry, did you already speak about it, or was it included in your answer? The PLI that you got for tablets and laptops?
Yeah. So we got the approval. Now presently we have also, our factories have been audited and qualified by one of the largest global brands. And now we are working with a partner to basically work out the numbers on the revenues, on the cost structures, and to ultimately arrive at the operating profitability. Also, we are in discussion with other brands as well. So similar to mobile scheme, in IT hardware also, Niraj, there is a separate track for domestic companies. So domestic companies, there are criteria which are defined, the investment criteria, sales criteria, or invoice value criteria have been defined for domestic companies, because the government objective is to create domestic champions in electronics. So we will be, so we should be a good, significant beneficiary under that.
So you have a mobile PLI, the IT and hardware PLI essentially encapsulates this laptop and tablet PLI, and you've also put in a PLI application with Bharti for the telecom hardware PLI, right?
That's right.
Is there any other one that you've done?
So apart from that, we will be doing for wearables and hearables. We understand that the government is planning to roll out a PLI for that. And this white goods PLI, which is basically the components for both AC as well as lighting, LED lighting components.
Okay. So in total, if everything goes as per plan, you might be operating under five PLI schemes in addition to the normal business that you anyways do.
A normal business is separate. Yeah, because we are expanding the capacities in a normal business as well. But yeah, these are the 5 PLIs that ultimately we should be a beneficiary of.
Saurabh, any fundraising that you need to do for any of these expansion plans? With an assumption that if you back the PLI schemes as well, would you need to fundraise?
So Niraj, if you look at our 30th June balance sheet, the net debt is still 54 crores on a 1,000 crore balance sheet. So debt to equity ratio is very low. And we feel confident that still with internal accruals and the cash flow now will also increase in the coming quarters. So with my cash flow from operating activities as well as controlled debt, because there's enough cushion in the balance sheet to take some debt, I think so we should be able to fund our capex going forward. Because working capital in our business, there is a huge focus on working capital management. It was just 0 days. The cash conversion cycle was 0 days. So it's just that we have to manage our capex. I think so we feel confident it can be done from internal accruals and some form of control debt. But having said that, Niraj, we have taken an enabling provision from the board, and it will also get approved by the shareholders in the August AGM. So yeah, we've got that provision in place. So if required, we can raise that money at a short notice.
But you being the man in charge of all things finance at Dixon, you don't foresee the possibility of that? It's just an enabling solution.
Yeah, I feel confident that it can be done from internal recruits and data.
Okay. Well, one production link question, Saurabh. Everybody is grappling with semiconductor issues. You guys will have some issues if execution steps up to full steam, or no, not quite?
No, absolutely. It's an industry issue. We are also facing significant supply chain constraints of semiconductors across all our businesses. So in lighting, we did a good strategy. We took a strategic call that we bought a lot of semiconductors, so which will put us in a very advantageous position in the industry. And as a result, we have a very good order book as well. But yeah, it's an industry-wide issue, and clearly it will take some time for this issue to be completely settled. Yeah, but this is an industry issue for us, for automotive, yeah, for a lot of industry.
But you don't foresee that to hamper the kind of targets that you have in store for FY22. You still believe that that is achievable, or would it be dependent upon normalization of supplies?
Yeah, so we could have done better, I would say, but the numbers that I shared with you are broadly takes into account the shortage of components as well.
Okay, great. Saurabh, so broadly the year will be characterized by hopefully the kind of revenue growth that you spoke about, maybe slightly lower margins, but FY23 onwards that could also come back, and you anyways foresee margins to normalize starting Q2 itself. Is there something else that we missed, Saurabh, that you would want to address? We've kind of discussed order book, including new clients, new areas of work, and the margins as well. Is there something else that you would like to bring to our notice?
Pretty much covered everything, Niraj.
Okay, great. Saurabh, good. Glad that you could join us today and give us some sense. All the best for the quarters ahead, and keep up the good work.
Thank you, Niraj. Thanks a lot. Thank you.
Thanks. Yeah, pleasure is ours. Viewers, thanks for tuning in to this conversation.